Welcome, everybody. I must say that I think we have the best bumper music in town. Certainly worth tuning in just for the tunes. Today is July 22nd, and again, thank you all for joining us. My name is Mike Hengehold, and I'm here with Doug Johnson. Everybody's familiar with Doug. Doug is one of my partners here at HCM, and he is the chief investment guru here as well. First, some basic housekeeping issues. There is a Q&A box at the bottom of the screen. If you don't see it, if you hover around on there, it'll pop up. If you want to submit a question during the presentation, feel free to do so. Slides will be available at your request. So after the presentation, if you'd like to get a copy of the slides, we certainly can provide that for you. And we should have a replay up on the website sometime in the next few days. So that I think does it for the housekeeping. You know, I feel a little bit like a broken record here, and that's because for the last year and a half or so, all of these conversations we've been having have been focused around COVID, and today's is going to be no different in that regard, especially as some of the variants, this Delta variant seems to be rearing its ugly head. You remember back when the vaccine news started to come out and the vaccine news was good. What we talked about a lot was reshaping the portfolios to take advantage of reopening stocks. And the reopening stocks are the types of companies that would benefit from people's willingness to travel, people's willingness to go to restaurants, the simple ability to go to work, get kids into childcare, things of that nature. Another big element of this had to do with the fact that the government has modeled a lot of its stimulus efforts around these types of events as well. You know, what's the likelihood that the economies will be slowing down because of COVID? What's the likelihood that we're going to be coming out of it with vaccines? So all those things have a bearing on the financial markets, obviously. So as things did start to improve, we allocated funds to these reopening stocks and away from defensive companies, and that turned out to be a pretty good decision. Now, however, we find ourselves in what at this point, I guess we're expecting is sort of a halftime or an intermission. But what we're seeing is that the Delta variant and quite frankly, the threats of inflation, that's another thing that you see in the news a lot lately. But these are creating some drag on the financial market and potentially creating some risks that the spike in growth is behind us and that the trend in growth will begin to decay. We see that in confidence surveys. There are several confidence surveys have shown that since June, consumer confidence has been coming down a little bit. Not a lot, but again, that the peak might be behind us. Asset class performance is demonstrating this to some extent, market breadth to some extent. But I don't want you to think that this is somehow we're forecasting bad news, because I think before we jump to any conclusions, we have to address the fact that this could really just be short-term noise. You have to remember that in the United States and in most other big countries now, we're enjoying relatively high vaccination rates, and we have very effective vaccines. So even though people might be getting sick, they're staying out of the hospital, and obviously the mortality numbers are way down. And you know, one maybe upside of some of this activity could be a refocus, or having those who are not yet vaccinated think about this again in order to help protect themselves and their families. And of course, the more of that we get, the closer we're going to be to that herd immunity that the doctors have talked so much about. So the reality here is it's very possible that we just might be in the process, and I hate this term because it's been used and used and used and overused, but we might be approaching sort of a new normal where we are watching the world adjust to what a post-pandemic or post-crisis world would be, where we're simply living with the COVID virus. We're keeping it in check with vaccines and potentially booster shots and things of that nature. And we're just going to go about living our lives. But the thing is, this is going to be a herky-jerky process as we get there. But the odds are that's probably what's happening. You know, there's an article in the paper in the Wall Street Journal today that talks about the fact that England has decided, Boris Johnson has decided that that's the experiment they're going to run. They're basically telling people to go live their lives individually. People should decide if they want to go to big gatherings or not, if they want to wear masks or not. They're seeing about 50,000 new cases per day, but their hospitalizations are very low. I think Doug is going to address this in just a few minutes. So these are evolving issues, and I think that the reality is we're never going to know a final answer here, because this, again, it's going to be something that's sort of constantly developing. At HCM, our goal is to understand the cycle and position ourselves accordingly. So again, thinking about, we're going through a phase where we're in the reopening phase, and so we want to lean in that direction. Now, if we're in an intermission phase or a halftime phase, while we're going to see if we can, if the vaccines can keep this new variant in check, that's going to require some adjustments. Then presumably we'll go through and get back into the reopening phase again. So that idea of being in sync with the cycles is really where our focus is. So with that said, those are sort of my opening comments. So Doug, where are we going from here?
Well, I think if for the movie buffs on here, they can notice the DeLorean on the screen, relate that to the movie Back to the Future. And I think, you know, one of the underlying themes of this presentation is, are we going back in time? Are we going back in time with COVID? Are we going back in time with economic growth? Are we going back in time with the leadership from the market? And really, when we say go back in time, we're not going back to 1984, 1985, or whatever year they went back to. We're talking about just going back to 2020, because the environment that we saw for a good portion of 2020 was very different than the one that we saw for the beginning of this year. And you mentioned the reflation theme, and that's something I think we've talked about quite a bit over the last, I'd say 6 to 8 months. And now I think we're seeing things in the market that are maybe giving us a little bit of pause there and saying, okay, is this in fact, as you mentioned, an intermission, or are we starting to get into this time machine and go back to what we saw last year? So you've seen this chart before. This shows COVID case counts in 4 separate countries. Now, we chose these specifically, the first 3, because they're 3 of the highest vaccination rate countries in the world. So you have the United States, and let me just pull up my laser pointer. Just a second. There we go. So here in the top left, you have the United States. We can definitely see an uptrend here in cases over the last month and a half. Certainly nowhere back to the peak that we saw at the beginning of this year, but a trend that's moving higher nonetheless. United Kingdom, same story, a much more aggressive rise in cases, almost back or surpassing the highest level that they had at the beginning of the year. And then you have Israel, which has seen a much, I'd say, flatter increase in their case counts. But again, these are 3 of the countries that have the highest vaccination rates in the world, and we're starting to see case counts move higher in those areas. So the market has looked at that and said, okay, as this Delta variant kind of spreads around the world, how is the vaccine going to hold up and effectively keep the reopening that we've seen on a more permanent basis, as opposed to seeing anything more regressive, which was actually seen in some of the other areas of the world. But one chart that I think is worth paying attention to here on the bottom right is India. So if you remember back 2-3 months ago, India had one of the worst outbreaks that we've seen since this has started. they topped out at an average daily case rate over 400,000 for about a week. And there was concern that the outbreak there was going to just overwhelm the country, overwhelm the medical system. Their vaccination rates were very low, and there was concern that it was going to overwhelm everything. Well, if you look, they reached that peak and then they came down very aggressively and have very much normalized to back to the levels that they were at before the spike happened. Now they're still trailing the U.S. And these other countries in vaccinations, but I think it does show a little bit of promise here that if we were to see a spike in cases, I don't know that it's going to be a permanent issue that's going to stick around. So I think more importantly, if we go and look at hospitalizations, we see maybe a different story. Now, understand that there's been a natural lag between case counts and hospitalizations, but if you look here, the three countries that we highlighted on the last slide, you have the United States, the UK, and you have Israel, all of them still showing very low levels of hospitalizations. This is important because if you remember, the initial lockdowns and the subsequent lockdowns were very much based on the case counts, but they were also based on the fact that the medical system was being overrun, that hospitals were up to capacity, and there had to be a way to lessen that burden, so to speak. So, not being in the medical field, it feels like what we're seeing is that as vaccination numbers continue to increase, just because the case counts are going up, it seems like the hospitalizations so far are staying somewhat level. And I think that's an important thing to note if we're trying to map out whether or not we're going to see a permanent reopening and maybe the continue of a reflation trade, or if we're going to go back to more regressive measures in that respect. Now, as we move on from the COVID picture, we go into more of the economic data. Now, this chart shows PMI output, which is just kind of a measure of business growth in the US. So what you can see is from 2010 up to the pandemic, you had fits and starts. This gray bar here denotes GDP growth, and everything kind of stayed in this, I'd say 65 to 45 range for the most part. Not, you had your ebbs and flows, but nothing really significant. Then obviously we run into the COVID situation here. You got a huge drop in GDP, a subsequent drop in output, and then we've had this boomerang recovery all the way up here. If you can remember back to the last presentation that we did, we talked a lot about base effect. And basically what we're seeing with the base effect is we're starting to roll off the year-over-year comparisons that we saw at the very bottom trough of the COVID outbreak, so to speak here. So we've seen really good rebound numbers, but there's now concern in the marketplace that we may have reached the peak of that growth. Not that the growth isn't going to continue, but that the rate of change or the rate of growth is not going to be as fast or accelerate at the level that some had predicted. Now, again, this doesn't mean that everything's going to turn around and we're going to all of a sudden go into this, recessionary environment. All it means is that I think when people look at the reflation trade and the things that were going to be the biggest tailwinds for that, if we have reached peak growth and we're starting to go and decelerate a little bit, that's going to, cause, I think, some investors to maybe begin to back off some of the investments that they made in the reflation trade and start to consider some other options going forward, or at least kind of take a more neutral stance until there's what I would say a little bit more clarity in terms of not only the COVID cases, but also in what we've seen in economic growth. Now, we've mentioned travel. Mike mentioned it earlier, that we've used this chart before as well. So this is the TSA checkpoint travel numbers on a 7-day average. So it really just denotes the amount of people that are traveling via planes in the country for a given week. So the 2019 here, the light blue line is kind of the normalized level of travel, so to speak. you've got the dark blue line here with COVID all the way at the bottom. And then you have this 2021 line in red. And then the dotted line here is a percentage of 2019. So what we can see is that since the beginning of the year, this number has continued to trend up and at a pretty good rate. So I think what it shows is that even with the advent of the new Delta variant, we still have people getting out. We still have people traveling. And when we're looking at pros and cons of reflation, I think we can argue that this is certainly a pro. And if this trend can continue, we're moving back to the level that we saw pre-COVID. Now, kind of a complementary thing to this would be hotel occupancy. So same story with this chart. The blue line here denotes the median level from the year 2000 to 2020. And you can see the red line is almost all the way back up to that level. So again, people are willing to go out, they're willing to travel by air, they're willing to go to hotels, they're willing to go out to eat. So the reopening that we've seen, although it may be slowing slightly, it's certainly showing the momentum that we expected to see as we talked about reflation for the past 6 months. Now, one of the concepts that we've run into over the past, I'd say, month and a half is as we've seen worries about the reflation trade pop up, you've seen a change in leadership in the market, so to speak. So whereas the first 4 months of the year, you had your cyclicals, you had small cap, you had very value-oriented things leading, things that were very sensitive to economic growth. What we've seen recently is kind of a counter shift to that. You've seen the stay-at-home names start to advance, more the deflationary, or if we're looking at it value versus growth, more of the growth names. So I think this chart does a good job of kind of showing that ebb and flow. And this is maybe on a little bit shorter time frame, but what you're seeing is the blue line here would denote a reflationary trade going up, whereas the blue line, or the green line down here would note the deflationary trade going down. These have kind of come and reached this point now. And we're not saying that these are going to continue to ebb and flow like this for the foreseeable future, but for right now, they're seeming to kind of crisscross back and forth with each other, based on the message or what day of the week it is. So as we talk about portfolio positioning and kind of what we've done recently, I think we've tried to neutralize our exposures a little bit more before we can get a little bit more clarity on what the future might hold. And once we can get that clarity, I think we'll have a better idea of what the market leadership might be on a more sustainable basis.
So
go ahead.
No, I think this is probably what you're about to get into. I think the point is that what we refer to as the reflation trade, those types of stocks were rocking and rolling all year long. And then when the COVID variant Delta began to scare people, we just sort of went back to, not as drastically, but basically went back to the game plan for last year when COVID was slowing things down. Basically, the fear of the unknown has driven people just to pull back a little bit, not be quite as aggressive.
Yeah, no, I think that's a great way to phrase it. And here you can see the year-to-date equity performance. The green and blue line here, value and small cap. You can see the gap over the market, international, and growth here, through the end of March. And then all of a sudden we started to see that leadership change. Small cap started to move lower. You have value still, maintaining a pretty wide margin, but over the past few weeks specifically, starting to work its way down, while the laggards for the beginning of the year starting to move their way back up. So things are starting to cluster back together a little bit. But if you take it on a year-over-year basis, really going from the election, which is this inflection right here, you still can see that small cap and value, or the reflation assets, still have a pretty good lead over some of those growth assets, and then certainly international down here. So again, we were able to participate in that reflation trade at the beginning of the year. but as we've moved and seen, the data points shift and some questions pop up, we've certainly taken the opportunity to take some of those profits and readjust portfolio exposure a little bit there. So, Mike, you mentioned in your last blog post the possibility of the Fed talking about a taper coming up. Now, I'm going to show a very brief clip here of Chairman Powell, and we're only going to watch about 10 seconds of it, but I want everyone to listen closely to what he says here. And this is pretty recently when this came out. Okay, so that was quick. Let's play it one more time just so everyone can hear it.
Okay. For what it's worth, I'm not hearing it.
You're not hearing it?
No, it's not playing on my end.
All right. Well, let's try it again. All right, one more time.
We're not even thinking about raising rates. We're totally focused on.
Better?
Better.
Okay. So for those who might not have caught that, basically what Chairman Powell said was they're not even thinking about raising rates. So really low rates forever. Now this was pretty recently, but at the last Fed meeting in June, all of a sudden you got the introduction of the possibility that because of inflation, rates may have to get raised sooner than they thought. So here's Chairman Powell again looking at his watch. He's saying, well, I guess it's time to start thinking about tapering. And as we've kind of alluded to in the taper blog that Mike put out, I don't know that the Fed wants to raise rates, but I think that they're looking at the inflation data out there and they're having a hard time continuing to say with a straight face that this is all transitory, so to speak. Now, they may be proven right eventually, but I think the market in a way is saying, this is not transitory. The supply chain issues that we're seeing, the inflation numbers that we're seeing, it's going to eventually lead to an environment where it may be too late. And when we look at this rate chart here, so the CPI index is in purple. And you can see from the beginning of this year, this number has shot up pretty aggressively. You've got market inflation expectations here in green, but oddly enough, you've got the 10-year Treasury here in orange. You have the Treasury yield curve spread between the 2 and the 10-year bond in blue, and those seem to be going in the opposite direction. And they seem to be doing this in the face of the headline here: inflation spikes in June to the fastest pace in 13 years. Okay. So normally you would see a headline like that and you'd think, okay, rates are going up, but they're actually doing the exact opposite. So as we've talked about some of the things that have given us pause in terms of the reflation, this is one of the things that I think really needs to be paid attention to closely, because the bond market is telling us that this reflation trade may in fact, I don't want to say it's over, but it's certainly reached a level where, Mike, I think the word you used was an intermission, so to speak.
Right.
So where does that leave rates for the rest of the year? So here is a scatter plot. This goes back to 1991. And the bottom shows US core CPI, which is just, the one of the measures that we use for inflation. And it's a year over year number. From 0 to 6%. And then here on the left, we've got the US 10-year Treasury. And then you have a regression line that just runs right through there. It just shows basically the trend of all these dots. So what you'll see is when, or at least historically, when CPI is high, the 10-year Treasury yield is subsequently high as well, denoted by all these dots. Now the red dots here show the last 5 years. So under a very aggressive, accommodative policy, when we've had any level of inflation, they've all been fairly low. Now what you've got is April, May, and June. So the last 3 months that we've seen, we've got CPI of 3 year over year, then close to 4, and now 4.5 in June. Yet all of these dots remain very much outliers in this area with the 10-year Treasury yield where it is. So a lot of strategists, us included, have looked at this and said, okay, is this telling us something about the recovery? Is it telling us something about the market? Is it telling us something about the leadership? Or has the Fed just distorted the Treasury market so much that it's impossible to gauge any level of predictability from what rates are telling us right now? I would say that we've certainly seen, going back to the theme, are we going back in time? We've certainly seen the trends that were dominant for a majority of 2020 becoming market leaders over the past few months. So you've got your growth names, your tech names, things along those lines. But even on Wall Street, most of the strategists, this is Goldman Sachs, a very well-known Wall Street bank. Here's their rate forecast for the 10-year Treasury for the foreseeable future. So currently, when they ran this, the rate was at 124. Their prediction is for a 1.9% 10-year Treasury at the end of this year, 2.10 at the end of 2022, 2.3 2023, and then 2.4 2024. Now, the futures market, which is just basically a market kind of aggregation, is a little bit lower than that, but nonetheless, the rate trends here are still higher. So if Goldman Sachs ends up being correct with their forecast, and not saying that they're in the know better than anybody else, but let's say that they're correct, the 10-year bond's got a long way to move in terms of yield higher. And we would have to expect that if that does take place, it would be under the umbrella of inflation and some, sustainable level of growth in the economy, which what we saw at the beginning of the year should be a tailwind to those value cyclical reflation assets. So the idea that the reflation trade is completely dead, I think, is a little bit premature. At the same time, I think we also have to respect what the bond market is telling us right now, knowing that these forecasts can change based on certain things that we might see pop up along the way. But
before we leave this, I think a point to, or an observation about it to be aware of is, remember that when rates go up, bonds go down. Pretty simple concept. And we have a situation right now where sort of the official 10-year money is where's today, Doug?
I think today 10-year bond closed around 1.3%, 1.27.
1.3% when inflation is substantially higher than that means that real interest rates are negative. That is an unnatural state of existence, and it only exists in states of great fear. We certainly don't have that. Or when, in this case, the government is generating forces that we either appreciate or don't appreciate. And so we're saying this is sort of the conundrum in the market now among strategists is exactly what are those forces, because it shouldn't be this way. Can you go back one slide, Doug?
Mm-hmm.
This kind of reminds me of watching Sesame Street with the kids when they were little, and you have to pick out the thing that doesn't belong. There are a lot of observations on this chart, and then find June of 2021. That it just doesn't belong there, but that's where it is. And so something has to change. And this is, so we talk a lot about stocks, but Doug, you might want to just talk for just a few seconds on what we've done on the fixed income side based on these observations as well.
Sure. So to touch on that, here is a composite of fixed income returns this year. As you can see, the only line on this chart that's positive is the high yield bond ETF. Everything else with a negative return, depending on how much duration the investment has, the more negative the return is. Now, this is a problem.
What is duration?
Duration is just a fancy way to describe the way that rates and bond prices move. So you have duration of 5 in a bond, rates go up 1%, the price of that bond should go down about 5%.
Yeah, you're just using words I don't understand. So duration means it's a 30-year bond has more duration than a 1-year bond. But the longer it is, that's long-term stuff is, yeah.
So the better way to phrase it is, if rates are going up, you don't want a lot of duration. That's bad, and vice versa. So, I think, we brought up this conundrum at the end of last year. And I think we've talked about it a little bit before then. And I think we were pretty active in adjusting fixed income allocations at the beginning of the year to battle the idea of rising rates and real or negative real rates, so to speak. So we took some of the duration in our bond portfolios lower and added some more, I guess you call them alternative fixed income products into the portfolio that gives us a little bit of latitude to move into other areas of the market that maybe don't have as much interest rate risk in them. So far that those decisions have paid off well, and I think for the time being, we're going to continue to let those do their job until we can maybe get a little bit more clarity on what we've seen in the rate market. So as we transition out of kind of the fixed income world, wanted to just spend a real brief amount of time here talking about what we might expect for the rest of the year. If you've heard me talk about outlooks and things like that, you'll know that I'll almost never give a defined number to anything, just because I think it's more of a guess than anything else. But what we have noticed is that expectations from investors are starting to become extremely distorted. So Natixis Investment Managers recently did a survey of 750 U.S. individual investors and found that the expected annual equity returns of this group was 17.3% per year. This was up from 10.9% expected in 2019, and it's almost double the average of 7.1 since 1926. So we've got this cartoon on here, and it reads, "Watching cartoons growing up gave me unrealistic expectations of how often pianos fall out of the sky onto people." So what is happening here is investors are extrapolating the returns that they've seen over the past few years and essentially assuming that that's going to be the environment for the foreseeable future. Now, let me be the first one to say, if they're right, that will be an absolutely awesome environment. And I don't think anyone will complain about it. But history has shown us that there's a high likelihood that that's not going to happen. In fact, it'll probably be the opposite. And as we make those considerations, I think it's important to realize that, planning is a very important aspect of the total relationship that we have with our clients. We spend a lot of time focusing on the investment side of things, but the plan kind of uses the portfolio as a way to determine whether or not a client's going to be able to reach their retirement goals. So as we start to look at plans going forward, we need to make sure that we're considering all the scenarios and not assuming that, hey, we're going to have 17% equity returns going forward, because I think we can all agree that that's probably not a realistic way to look at the world, even though we've seen really good returns over the past few years. So what can we expect for the rest of the year? This is a good chart that shows historically, if the Dow has a positive performance in the first half of the year, what we can expect is a full year return. These are broken out into number of years, going back 124 years, all the way back to 1896. So a lot of data on here. But the Dow was up double digits through the first half of this year. So we go right here. So whenever we've had a year where the initial gain is between 10 and 20%, 23 times in history, we had a full year return that was positive. Only one time we had a return that was negative. So what I can tell everybody is that the chances of returns being positive this year are probably pretty good. We don't know exactly what that number is, but we think that with the accommodative policies that we've seen, with the trajectory of economic growth that we've seen, with projections for earnings growth that we've seen, there's a good possibility that this environment is going to remain accommodative for equities going forward. Does that mean we're going to get another 10% at the end of the year? Could be. Will we stay right where we are? Again, don't know, but history would pretend that this year is going to end up being a positive year overall in the market. So lastly, as we get a lot of questions about valuations and concerns about things going forward, there can be a tendency to use valuations, excuse me, as not only a timing tool, but as a way to determine how bad a particular correction or a bear market could be. So we look at valuations now, and I think that we would all agree that they're touching some very historic levels in terms of the normal things that we've looked at. And I think some people look at that and say, well, if things are this high, the downside to this is going to have to be massive. And that's not necessarily the case. It could be, but it doesn't necessarily mean that has to happen. So here this breaks out. So market losses. So bear markets that began when the PE ratio was the lowest actually produced the largest drawdowns in terms of bear markets, and the highest produced a lower level. Now, granted, 30% bear market is still a significant drawdown, but this is, I think, the exact opposite of what most people would expect. Same thing with the CAPE ratio. Now, the CAPE ratio is just another way to express price to earnings. It's a inflation-adjusted measure and goes back about 10 years in terms of looking at earnings and adjusting those for inflation. But again, same story. The lowest PE ratios for the market overall led to the steepest drawdowns in terms of bear markets and vice versa. And then when we look at the length, same story. Lowest PEs led to the longest bear markets, while the highest PEs led to the shortest bear markets. So, understanding that we can look at valuations and see that they are high. It doesn't really give us any indication on short-term timing, and doesn't mean if we do get a correction that it's going to be any better or worse compared to if PE levels were any lower from the starting point. So I think that's an important consideration to look at right now, as we can see many charts and graphs that show, take your pick of said fundamental ratio and look at it and say, wow, things are really really crazy out there. So in terms of questions, I think that's the end of the prepared presentation now, so we can get into some Q&A. So Mike, one question I think kind of is maybe prodding us a little bit on the issue that we just looked at, but is there anything more specific we can provide for maybe outlooks for the remainder of the year?
Wow, look at the time. So we obviously talk about this a lot. I think the reality is we have these unknowns that we've talked about, but for planning purposes, our belief is we are in this intermission stage where we have this learning period to deal with these new variants, assuming that goes well, and that what we see are, certainly the unvaccinated people have a higher probability of getting sick now because this thing is 3 times as contagious as the original COVID. So those people can get ill, and they can get very seriously ill. But among the vaccinated, it seems as though this experiment that I mentioned that England is on, should be fairly supportive of returning to normal. There are a number of reasons to believe that the inflation scare that's all being discussed is transitory. That's currently our base case assumption. There are a lot of reasons. That wasn't really the thrust of today's presentation, but there are a lot of reasons to believe that's going to be the case ultimately. But again, the market has to work its way through that to get to that conclusion. There's this sort of mystery force that's keeping the bond market, particularly the treasuries that Doug was discussing, at negative real levels, and just the 1.2, 1.3, 1.4 as it moves around in a world where inflation is more than twice that. And that's the guiding hand of the Federal Reserve, and a theory that was surfaced popularly during the last election. I believe it was Andrew Yang, is that right, Doug, the MMT, who proposed modern monetary theory is a concept that's gaining some momentum, and essentially at the core, I'm oversimplifying, but it says deficits don't matter. Well, that's a very new way of thinking about money, and then the forces of the government, printing funds wildly. We are about to see, presumably, if politicians do what politicians do, we're about to see an infrastructure bill that is either the Republicans cooperate with the Democrats on the first tier in order to provide the traditional infrastructure. And if they do, the president has said, although he walked it back because it didn't play well in the polls, but he has said that the first round of stimulus and the second round, the $3.5 trillion bill is linked. So they would hopefully pass the first one with bipartisan support, and then do the second one on their own. So when you weave all these things together, the notion of the world being awash in money, and I would say that so we're a little bit ahead of the curve in terms of talking about tapering and raising interest rates. And when you look at the EU, for example, they're still loosening up and looking at a lot of stimulus. So the odds are that what we've been through, we're going to be able to take advantage of a typical cycle there as well. But the moral of the story is there's going to be lots of money with this MMT concept floating around that should allow equities to be productive for much longer than they would typically be in a traditional cycle. That doesn't respect any black swan events and so forth, and certainly a lot of things can happen. But if the world stays safe and basically all we have is a new version of the flu, we're awash in funds, the Fed keeps its promise and doesn't raise rates or taper anytime soon, this party could go on for some time. I would just say that we would expect we would expect volatility to go back to at a minimum normal. Again, if you think this week the market sold off something like 800 points on Monday, if you were on vacation for a couple of days and checked your account today, you wouldn't even have known it happened. So it's not that volatility is bad. In fact, this notion of volatility versus risk is going to be the subject of our next video, but we're going to get a little long-winded here. Again, as Doug said, we're not going to pin numbers on it, but we're optimistic that the party has a way to go yet. Doug, anything that I missed there?
Yeah, I mean, the only thing that I would add to that is in August, the Fed is going to have a meeting in Jackson Hole, which will be scrutinized beyond belief for anything that can be taken out of that. I think if they were to give any hint or indication that their rate hike timeline has moved up, I think you could see increased volatility in the market, because the last time the Fed tried to raise rates or normalize rates, the equity market did not care for it. And even the mention of moving up the timeline by 1 year for a 25 basis point hike caused a lot of volatility just a few weeks ago. So I think a lot of eyes will be on that meeting, and I'll be interested to see what the outcome of that is.
So yeah, so I think that underscores this notion of volatility. There's, I was reviewing data the other day that, the number of days since we've had a 5% correction, a 10% correction, a 15% correction, we're getting pretty long in the tooth, with the exception of the NASDAQ, which in this whole value growth discussion did swoon earlier this year. Of course, it's now coming back again. But we've mentioned in many of our blogs that should this occur at this point, we're going to view those as opportunities rather than threats. At this point, we expect the volatility. In fact, I'm kind of sorry we haven't had it, because it's those times when others are panicking that you can get your best positions. It kind of disarms some of this issue. Are the markets expensive? If we could have a nice 10 or 15% pullback, that would create some opportunities that we would love to take advantage of.
Yep, I think we're right at time here, so no other questions, Mike, if you want to take us out.
All righty. Well, obviously, I want to thank everybody for spending this 45 minutes or so with us. With summer activities, we are going to, our next scheduled event will be for September 23rd. Obviously, the promise is out there. If news breaks, we'll be back. We'll certainly be writing. We're introducing these videos, and Doug and I would be back for a call if that was needed. So, and I would also say, as always, if you have any questions, certainly feel free to reach out. As COVID is breaking, we're doing a lot more in-person meetings again and things. So if you're comfortable with that, we're good. Otherwise, we're always open for video conferences and so forth. I was hoping to have tax news for this meeting, but as the expected date of a infrastructure program got punted yesterday, we're still probably weeks away from seeing what the actual tax proposals will be. That's going to be very important as we get into the end of the year tax planning, especially for higher income clients, those that are still working, or those that are in transition to retirement. We do expect there to be a change in the required minimum distribution age this year. That deal is pretty much already signed, but it's having trouble getting out of getting. I mean, it's been agreed to on a bipartisan basis. It's having trouble getting signed, but it will happen, and that'll take the RMD age to 75. Otherwise, again, if you have questions, give us a holler. If there's somebody that's planning retirement and could use our help, we'd love to chat with them. We'll help them any way that we can. I think that does it, everybody. Again, thanks for tuning in. Bye-bye.